The hidden powerhouse. Imagine waking up in the heart of America, grabbing your morning coffee and heading off to work at a tech giant. Maybe you're scrolling through your iPhone, paying for gas with your Visa, or catching the news on a major network. It all feels like the classic American dream: choice, competition, and freedom in a marketplace built on innovation. But what if that sense of choice is just a carefully crafted illusion? What if, behind the scenes, the same invisible hand is quietly steering almost every major company you interact with, from the brands in your fridge to the apps on your phone? This isn't the plot of a Hollywood thriller or some wild internet conspiracy. The truth is far stranger and much more real. At the center of this web sits a company most Americans have never visited, headquartered not in New York or Silicon Valley, but in a quiet suburb of Pennsylvania. It's called Vanguard, and it's not just another Wall Street firm. In fact, it's not like any other financial institution on earth. Vanguard is the ultimate financial paradox. It's a company that manages more than $8 trillion in assets. Yes, trillion, with a T, yet it doesn't have the glitzy image of a Wall Street titan. It doesn't chase headlines or splashy ad campaigns. Instead, it operates in the background, quietly accumulating ownership in nearly every major public company in the United States. If you look at the shareholder lists of Apple, Microsoft, Coca-Cola, or even the banks that hold your mortgage, you'll find Vanguard's name at or near the top every single time. But here's where things get truly bizarre. Vanguard isn't just big. It's structured in a way that defies everything we think we know about American capitalism. Unlike traditional corporations, Vanguard doesn't have outside shareholders demanding profits. It doesn't answer to Wall Street analysts or private equity overlords. Instead, it's owned by its own funds, which are in turn owned by regular investors, people like you and me. This mutual ownership model means Vanguard's only real boss is the collective will of millions of everyday Americans, most of whom have no idea how much power they actually wield. And yet, despite this democratic-sounding setup, Vanguard has become the single most influential force in the American economy. It's the silent giant in the boardroom, the hidden hand behind the brands you trust, and the quiet kingmaker shaping the future of corporate America. But how did a company with no profit motive, no flashy CEO, and no traditional owners end up controlling the levers of capitalism? The answer is stranger than fiction, and it all started with a single, fateful decision in the 1970s. But that's just the beginning. The real story of Vanguard's rise is even more unbelievable, the birth of a financial anomaly. To understand how Vanguard became the most unusual powerhouse in American finance, you have to go back to the chaos of the 1970s. The US economy was in shambles, sky-high inflation, a stock market in freefall, and a sense of uncertainty that rattled even the most seasoned investors. In the middle of this storm stood a man named Jack Bogle, a sharp, ambitious executive at Wellington Management, one of the oldest investment firms in the country. Bogle was known for his bold ideas and relentless drive, but one disastrous merger cost him his job as CEO. Most people would have faded into obscurity after a setback like that, but Bogle wasn't most people. Thanks to a quirky legal loophole in Wellington's charter, Bogle managed to stay on as chairman of the company's funds, even after being ousted from the top job. The catch? He was banned from making investment decisions. Imagine telling a star chef he can stay in the kitchen, but he's only allowed to wash dishes. For most, it would have been humiliating. For Bogle, it was the spark that ignited a revolution. Bogle started digging into the data and made a discovery that would shake Wall Street to its core. He realized that most professional fund managers, the so-called experts, weren't actually beating the market. After you factored in their hefty fees and taxes, almost none of them delivered better returns than simply owning the entire market. So if he couldn't pick stocks, why not just buy them all? No fancy analysis, no high-priced gurus, just a simple low-cost way to own a slice of every major company. This was the birth of the index fund, a product so radical that Wall Street laughed it off as Bogle's folly. But Bogle wasn't done flipping the script. He decided to structure his new company, which he named Vanguard after Admiral Nelson's flagship, in a way that was completely foreign to American finance. Instead of being owned by outside shareholders hungry for profits, Vanguard would be owned by its own funds, and those funds would be owned by the investors themselves. In other words, if you put your money in a Vanguard fund, you became a part owner of Vanguard. There were no outside investors demanding dividends, no Wall Street overlords calling the shots. Any profits Vanguard made were used to lower fees for its investors, not to line the pockets of executives. This mutual ownership model was so radical that Bogle's peers accused him of being un-American, even socialist. They couldn't understand why anyone would build a company that didn't exist to maximize profit. But Bogle saw something they didn't. By removing the profit motive, Vanguard could create a self-reinforcing cycle. Lower fees attracted more investors, which increased assets, which lowered costs even further, which allowed fees to drop again. It was a flywheel that would eventually leave traditional investment firms in the dust. Wall Street hated it. Competitors mocked the idea, printing posters that said, "Help stamp out index funds," but the joke was on them. What started as a punishment for Bogle became the foundation for a financial empire. Vanguard's unique structure didn't just change. The way Americans invest, it changed the very DNA of capitalism itself. And as Vanguard's assets grew, so did its influence. But the real twist: this socialist experiment would soon become the largest owner of capitalist America, setting the stage for a new era of power and control that no one saw coming. And the consequences of that shift are still rippling through the market today. The illusion of choice: walk into any American supermarket and you're greeted by a dazzling array of brands. Coke or Pepsi, Lay's or Doritos, Apple or Microsoft. The shelves and screens are packed with options, each one promising something unique. It's the very definition of capitalism: fierce competition, endless variety, and the freedom to choose. But what if that freedom is just a mirage? What if, behind the curtain, the same handful of players are quietly pulling the strings for both sides of every rivalry? This is where the story of Vanguard takes a turn from impressive to unsettling. While most people see a world of competing brands, the reality is that Vanguard and its close cousins, BlackRock and State Street, are the largest shareholders in nearly every major public company in America. It's not just that they own a piece of the pie, they own slices of every pie in the bakery. Take a look at the beverage aisle. Vanguard is a top shareholder in both Coca-Cola and PepsiCo. In tech, they're the largest owner of both Apple and Microsoft. In banking, they hold major stakes in JP Morgan Chase, Bank of America, and Citigroup. The pattern repeats across airlines, media, retail, and beyond. This phenomenon is called common ownership, and it's quietly rewriting the rules of the American marketplace. In theory, Coke and Pepsi should be locked in a battle to the death, slashing prices and fighting for every customer. But when the sane investor owns a big chunk of both companies, the incentive to compete aggressively starts to fade. Why would you want one company to crush the other if you profit from both? Instead, the goal shifts from winning the war to keeping the peace and keeping prices high. Academic research backs this up. Studies of the airline industry, for example, have shown that when Vanguard and its peers own large stakes in multiple competitors, ticket prices tend to rise. Executives know who their real bosses are. They don't need a phone call from Vanguard telling them to play nice. They just know that rocking the boat could upset the biggest shareholders in the room. The result? Less competition, higher prices, and a marketplace that starts to look more like an exclusive club than a free-for-all. The illusion of choice goes even deeper when you look at media and technology. Vanguard is a top shareholder in Comcast, which owns NBC Universal, Disney, owns ABC and ESPN, Paramount, which owns CBS, and even the New York Times. It's not about controlling the narrative in some smoky backroom. It's about risk management and stability. Vanguard's job is to track the market, not to make bold bets or take sides. But by owning a piece of everything, they become a permanent fixture in every boardroom, a silent partner who never leaves. This kind of common ownership breaks the traditional feedback loop of capitalism. In the old days, if a company made a bad decision or lost touch with its customers, investors would sell, the stock price would drop, and management would be forced to change course. But Vanguard doesn't sell. Their index funds are designed to hold every stock in the market, no matter what. That means even when companies stumble, the money keeps flowing in, insulating them from the consequences of their actions. It's a subtle but profound shift. The more money that pours into index funds, the more insulated the biggest companies become. They're no longer just too big to fail. They're too connected to fail. And as Vanguard's influence grows, the lines between competition and cooperation blur, leaving American consumers with the unsettling realization that their choices might not be as real as they seem. But the real power of Vanguard isn't just in what they own, it's in how they use their influence. And that's where the story takes an even more surprising turn: the passive power grab. If you've ever wondered who really calls the shots in corporate America, the answer might surprise you. It's not always the CEOs, the founders, or even the boards of directors. In today's market, the true kingmakers are often the massive institutional investors who hold the voting power behind the scenes. And at the top of that list sits Vanguard, quietly wielding influence over the fate of the country's biggest companies. For decades, Vanguard played the role of the silent partner. Their philosophy was simple: track the market, don't interfere, and let management run the show. Jack Bogle, Vanguard's founder, was famously skeptical of funds getting involved in corporate governance. He believed that if you didn't like how a company was run, you should simply invest elsewhere. But as Vanguard's assets ballooned into the trillions, that hands-off approach became impossible to maintain. When you own a significant chunk of nearly every major company in the S&P 500, your silence isn't just passive, it's a statement in itself. That's when Vanguard created its investment stewardship team, a small group of professionals tasked with voting on behalf of millions of investors. Most people don't realize it, but when you buy a share of a Vanguard index fund, you're handing over your voting rights. You don't get to decide who sits on the board of Apple or whether Exxon should pivot to green energy. Instead, a handful of people in a Pennsylvania office make those decisions for you, casting votes that can sway the direction of entire industries. This concentrated voting power has real-world consequences. In recent years, there's been a surge in shareholder activism around issues like climate change, diversity, and executive pay. Suddenly, companies aren't just answering to their customers or their employees, they're re-answering to the big three asset managers, Vanguard, BlackRock, and State Street. When these giants move in unison, their combined votes can tip the scales in any boardroom battle. A perfect example came in 2021, when a tiny activist hedge fund called Engine No. 1 launched a campaign to force ExxonMobil to add climate-friendly directors to its board. On their own, Engine No. 1 owned just a sliver of Exxon's shares, barely a blip on the radar. But when Vanguard, BlackRock, and State Street sided with the activists, the result was a seismic shift. 3 board members were ousted, and Exxon was pushed to rethink its entire strategy. It was a wake-up call for corporate America. Ignore the passive giants at your peril. This new era of passive power is both fascinating and unsettling. On one hand, it means that regular investors, through their retirement accounts, index funds have a voice in shaping the future of the world's biggest companies. On the other hand, it concentrates enormous influence in the hands of a few gatekeepers who may not always reflect the wishes or values of the millions they represent. The stewardship team's decisions are often made behind closed doors, with little input from the actual investors whose money is at stake. And as political and cultural battles heat up, Vanguard's voting power has become a lightning rod for controversy. Some state governments have accused the big three of using their influence to push political agendas, while others worry that too much power is being concentrated in too few hands. In response, Vanguard has started experimenting with programs to give some voting rights back to individual investors, a sign that even the giants know the spotlight is getting hotter. But for now, the reality remains. Vanguard's passive approach has turned into an active force, shaping the direction of corporate America in ways most people never see. And as their influence continues to grow, the question isn't just who owns the market, it's who controls it. And what happens when that control is tested by the next big crisis? The answer could change everything you thought you knew about investing. The market machine, if you've ever looked at the stock market and wondered why it seems to defy gravity, why stocks keep climbing even when the economy feels shaky, you're not alone. The answer, in part, lies in the way Vanguard and other index fund giants have fundamentally changed how the market works. What used to be a battleground of ideas, research, and price discovery has become something more automated, more predictable, and, in some ways, more dangerous. Let's break it down. In the classic model of Wall Street, active managers, think hedge funds, mutual funds, and day traders, would analyze companies, dig into financial statements, and make bets on which stocks were undervalued or overhyped. They're buying and selling set prices, rewarding good companies and punishing bad ones. This process, called price discovery, was the engine that kept the market efficient and honest. But Vanguard's rise has flipped that script. Index funds don't care about earnings reports, product launches, or even scandals. They don't try to pick winners or avoid losers. Instead, they buy every stock in the index in exactly the proportions dictated by the index itself. If Apple is 7% of the S&P 500, Vanguard buys 7% Apple. If Tesla's price soars and it becomes a bigger part of the index, Vanguard buys even more Tesla. It's a relentless, mechanical process, one that doesn't pause to ask if the price makes sense. This autopilot approach has created a powerful feedback loop. As more Americans pour their retirement savings into index funds, more money flows into the biggest companies, pushing their stock prices even higher. Those rising prices make the companies an even larger part of the index, which means the next wave of index fund buys even more of them. It's a self-reinforcing cycle that can send valuations into the stratosphere, regardless of what's happening in the real economy. Critics call this the passive investing bubble. Michael Burry, the investor who famously predicted the 2008 housing crash, has warned that index funds are inflating stock prices in a way that's eerily similar to the subprime mortgage crisis. His argument is simple. If everyone is just buying the market, Who's left to actually figure out what the market is worth? If the smart kids in class stop doing their homework and everyone just copies the answer key, eventually nobody knows the right answer. The risks go beyond inflated prices. When a shock hits the system, say, a sudden economic downturn or a geopolitical crisis, index funds don't pick and choose what to sell. They dump everything all at once. This can lead to wild swings where good companies get punished just as hard as bad ones, simply because they're part of the same basket. The more the market is dominated by passive investing, the more it moves in lockstep, rising and falling together in a way that can amplify both booms and busts. And here's the kicker: as index funds have grown, active managers have been squeezed out. Their higher fees can't compete with Vanguard's rock-bottom costs, so many have closed up shop or switched to passive strategies themselves. The result? Fewer people are left doing the hard work of price discovery, making the market more fragile and less resilient. It's a world where flows matter more than fundamentals, where the biggest companies get bigger simply because they're already big. And as Vanguard continues to vacuum up assets, the market becomes less about what a company is worth and more about how much money is flowing in. It's efficient, it's cheap, and for now, it's made millions of Americans wealthier. But beneath the surface, the machine is humming, and if something goes wrong, the gears could grind to a halt faster than anyone expects. But Vanguard's ambitions don't stop at public stocks. The next chapter in their story takes us into even murkier territory, where the lines between transparency and secrecy start to blur. The private empire and data dominance for decades. Vanguard's reputation was built on simplicity and transparency. You knew what you were getting: low-cost index funds, broad diversification, and a business model that seemed almost allergic to Wall Street's usual game. But as Vanguard's empire has grown, so has its appetite for new territory. And lately, the company has been quietly expanding into areas that are far less transparent and far more lucrative. Let's start with private equity. For years, this corner of the financial world was reserved for the ultra-wealthy and institutional insiders. Private equity firms would buy up companies, load them with debt, strip out value, and sell them for a profit. The risks were high, the rewards even higher, and the fees astronomical. Vanguard, with its for-the-people image, was supposed to be the antidote to this kind of high-stakes, high-fee investing. But as the public markets became saturated, Vanguard already owns a piece of nearly every major stock and bond. The company started looking for new ways to grow. Enter the partnership with Wildest, a major player in private equity. Suddenly, Vanguard was offering its clients access to private deals that were once off limits to regular investors. On the surface, this sounds like democratization now. Anyone can invest like a billionaire. But there's a catch. Private equity is a black box. Unlike public stocks, you don't get daily price updates or transparent disclosures. The managers themselves decide what the companies are worth, and the fees can quietly eat away at returns. For everyday investors, this means taking on risks they might not fully understand: liquidity, valuation, games, and the possibility of being locked into an investment for years with no easy exit. But the shift doesn't stop at private equity. Vanguard is also becoming a data powerhouse, quietly amassing a treasure trove of information about its clients. Think about it. Vanguard doesn't just know what stocks you own. It knows your age, your retirement goals, your risk tolerance, your income, your debts, and even your likely reactions to market swings. Through its personal advisor services and digital platforms, Vanguard is building a financial DNA profile for millions of Americans. Why does this matter? Because in the 21st century, data is power. While tech giants like Google and Facebook know what you search, and like Vanguard knows your financial future, they can predict when you'll retire, how much you'll save, and even how you'll react in a crisis. This gives Vanguard a massive edge, not just in managing money, but in shaping the very products and services it offers. They're already experimenting with artificial intelligence and blockchain technology to streamline operations and predict investor behavior. Imagine an AI that doesn't just forecast the market, but forecasts you. And it goes even deeper. Vanguard has started licensing its technology to other financial firms, quietly building the operating system for the investment world. If you're a financial advisor using Vanguard's platform, you're playing by their rules. They decide which funds get promoted, which strategies are highlighted, and which ones get buried. It's the financial equivalent of the Apple App Store. If you control the platform, you control the game. This centralization of data and technology creates a new kind of risk. If a hacker breaches a retailer, you might lose a credit card number. If someone breaches Vanguard, they could access the financial blueprints of millions of Americans, plus the voting rights tied to trillions in assets. Vanguard is famously secretive about its internal systems, operating more like a fortress than a fintech startup. But as more assets go digital and more advice is automated, the human element fades, and your financial future is increasingly steered by algorithms designed in a Pennsylvania office park. Vanguard's move into private equity and data dominance marks a turning point. The company that once stood for transparency and simplicity is now venturing into the shadows, building a private empire and a digital brain that knows more about American investors than anyone else. It's a subtle but profound shift, and it raises a new question. What happens when everyone is following the same playbook, guided by the same invisible hand? Because the next risk isn't just about money. It's about what happens when the entire financial system starts to look and act the same. The financial monoculture. Let's step outside the world of finance for a moment and talk about bananas. Not just any bananas, the Cavendish banana, the one you see in every American grocery store. Decades ago, there was a different banana, the Gros Michel, which was bigger and tastier. But farmers planted only Gros Michel because it was efficient and profitable. Then disaster struck. A fungus called Panama disease swept through, and because every banana was genetically identical, the entire crop was wiped out. The Gros Michel vanished from store shelves, replaced by the Cavendish, which now dominates the market. But here's the catch. The Cavendish is just as vulnerable. One new disease, and it could disappear too. This isn't just a story about fruit. It's a warning about what happens when diversity disappears and everyone bets on the same thing. And right now, the American financial system is heading down the same path, with Vanguard leading the way. Vanguard's rise has created what experts call a financial monoculture. Millions of investors, from retirees to young professionals, are following the same playbook by the S&P 5. Hold forever, rebalance once a year, and trust that the market always goes up in the long run. On the surface, this seems like the ultimate in safety and simplicity. But when everyone is following the same rules, the system becomes fragile, just like those bananas. In a healthy market, you have a mix of strategies. Some investors buy and hold, others trade actively, some short stocks, others focus on value or growth. This diversity creates stability. When one group is selling, another is usually buying. But as index funds like those from Vanguard swallow up more of the market, that diversity is fading. The same algorithm is guiding trillions of dollars, and everyone is reacting to the same signals at the same time. Jack Bogle, the father of the index fund, saw this risk before he died. He warned that if index funds ever controlled more than half the market, the system could break down. If everybody indexed, the only word you could use is chaos, catastrophe, he said. We're not there yet, but we're getting close. Index funds now own a massive share of the US stock market, and their influence grows with every paycheck that gets automatically invested in a 401k. The danger is what's known as a liquidity cascade. Imagine a crowded theater. In the past, if someone yelled fire, people would react differently. Some would run, some would stay, some would check if it was real. But in a monoculture, everyone is programmed to run for the same exit at the same time. If a major shock hits the market and index investors panic, there may be no one left to buy as everyone tries to sell. Prices could collapse in a matter of minutes, not days, because the market makers and active managers who used to provide stability have been driven out by Vanguard's low fees and relentless efficiency. This isn't just a theoretical risk. We've seen glimpses of it during flash crashes and sudden market drops where stocks across the board plummet together, regardless of their actual value or business performance. The more the market is dominated by passive investing, the more likely it is that a single event could trigger a chain reaction, with devastating consequences for everyone involved. Vanguard's financial monoculture is efficient, cheap, and so far profitable for millions of Americans. But it comes with a hidden cost: the loss of resilience, the disappearance of diversity, and the risk that one day the entire system could be brought down by a single unexpected shock. Just like the bananas, we may not realize how vulnerable we are until it's too late. But there's another layer to this story, a human one. Because Vanguard's rise hasn't just changed the market, it's created a movement, a community, and some would say a cult. And that's where things get even more interesting. The cult of the Bogleheads. If you've ever wandered into a personal finance forum or scrolled through Reddit's R Personal Finance, you've probably encountered them. They're the ones chanting VT Sachs and chill, quoting Jack Bogle-like scripture, urging everyone to ditch high-fee funds for the simplicity of index investing. They call themselves Bogleheads, and they're more than just fans of Vanguard. They're a movement, a community, and, to some, a full-blown financial cult. At first glance, the Boglehead philosophy is refreshingly straightforward. Save as much as you can, invest in low-cost index funds, ignore the noise, and let compound interest do the heavy lifting. Their sacred text is the Little Book of Common Sense Investing, and their prophet is Jack Bogle, the man who made investing accessible to the masses. For millions of Americans, this approach has been a game changer. helping regular people build wealth without the stress of picking stocks or timing the market. But dig a little deeper, and you'll find a culture that's as zealous as it is practical. Suggest trying to beat the market, and you'll be met with skepticism, if not outright scorn. Mention active management, and you'll be told you're gambling with your future. The Boglehead forums are filled with stories of converts, people who once chased hot stocks or paid high fees, only to see the light and embrace the gospel of passive investing. There's a sense of camaraderie, but also a strong undercurrent of groupthink. Dissent is rare, and when it appears, it's quickly drowned out by a chorus of stay the course. This unwavering loyalty is Vanguard's secret weapon. While other financial firms spend millions on advertising, Vanguard relies on its army of true believers to spread the word. They recommend Vanguard to friends and family, defend it against critics, and even stick with the company when competitors offer lower fees or flashier technology. The brand's deliberately plain website and no-nonsense marketing aren't accidents, they're signals of thrift and trustworthiness, reinforcing the idea that Vanguard is on the side of the little guy. But there's a paradox at the heart of the Boglehead movement. The very thing that makes index investing so powerful, its simplicity and low cost, also creates a free rider problem. Index investors benefit from accurate stock prices, but they don't pay for the research and analysis that active managers provide. In other words, they're drafting behind the hard work of others, enjoying the ride while someone else breaks the wind. As more people join the passive revolution, fewer are left doing the homework, and the system becomes more fragile. This isn't just academic theory. Even Jack Bogle himself warned about the dangers of too much indexing. If everyone becomes a passive investor who's left to set prices and keep the market honest, the Boglehead philosophy assumes that someone somewhere is still doing the work. But as the movement grows, that assumption becomes riskier. Still, it's hard to argue with the results. For most Americans, the Boglehead approach has delivered steady, reliable growth, helping millions achieve financial independence. But the cult-like devotion to Vanguard and index funds can blind even the smartest investors to the risks lurking beneath the surface. What happens if the market stops going up? What if the system that made index investing so successful starts to unravel? The Bogleheads are quick to dismiss these questions, confident that the market always recovers and that Vanguard will always be there. But as history has shown, no system is invincible. And as Vanguard's influence continues to grow, the line between smart investing and blind faith gets harder to see. But the story doesn't end with the Bogleheads. In fact, the next chapter is where things get truly wild, because when a company gets this big, the conspiracy theories are never far behind. Conspiracy and realities whenever a company grows as large and influential as Vanguard. It's only a matter of time before the conspiracy theories start swirling. Search for Vanguard online, and you'll find a rabbit hole of claims that Vanguard is the puppet master behind the world's biggest corporations, that it controls the media, that it's orchestrating a great reset to reshape society for its own benefit. Some even go so far as to suggest that Vanguard and its peers are the shadowy cabal pulling the strings of global events, from pandemics to political upheaval. Let's separate the facts from the fiction. First, there's no secret lair, no villain stroking a cat and plotting world domination. Vanguard isn't a single mastermind, it's a vast, bureaucratic organization filled with regular people, most of whom are more concerned with tracking error and compliance than with world domination. The company's unique mutual structure means that profits don't flow to a handful of elites, but to the millions of investors who own its funds, ordinary Americans saving for retirement, college, or a first home. But here's where the conspiracy theorists accidentally stumble onto something real. While there's no grand plan, the sheer scale of Vanguard's influence means that its decisions ripple through every corner of the economy. When Vanguard decides that environmental, social, and governance (ESG) factors are important, every major corporation scrambles to update its policies. When Vanguard shifts its voting strategy, boardrooms across America take notice. It doesn't take a secret meeting or coded messages, just a few lines in a stewardship report, and the market moves. This is the paradox of modern finance. Vanguard doesn't need to conspire to shape the world. Its influence is automatic, a byproduct of its size and the passive flows it commands. When you own a significant chunk of every major company, your preferences become the market's marching orders. If Vanguard signals that diversity, climate risk, or corporate governance matter, though, priorities quickly become the new normal for the entire Fortune 500. The result is a kind of great sameness. If you've noticed that every big company seems to have the same bland PR statements, the same corporate art style, the same cautious approach to social issues, you're seeing the Vanguard effect in action. It's not about controlling the narrative in a smoky backroom. It's about minimizing risk, maximizing stability, and keeping the index humming along smoothly. The side effect, a corporate landscape that feels increasingly uniform, safe, and some would say soulless. Of course, this concentration of power isn't without its critics. Politicians on both sides of the aisle have started to question whether it's healthy for a handful of asset managers to wield so much influence over the economy. Some states have launched investigations, accusing Vanguard and its peers of using their voting power to push political agendas. Others worry that the lack of transparency in how these votes are cast leaves too much power in too few hands. Yet, for all the noise, the reality is more mundane and in some ways more unsettling. Vanguard's power doesn't come from secret meetings or hidden agendas. It comes from the collective choices of millions of Americans who, seeking low fees and steady growth, have handed over their financial futures to a single, silent giant. The real risk isn't a conspiracy, it's the slow, relentless drift toward uniformity, where innovation and risk-taking are replaced by caution and consensus. So, while the internet may be full of wild theories about Vanguard's secret plans, the truth is both simpler and more profound. Vanguard's influence is real, but it's not the result of a master plot. It's the inevitable outcome of a system that rewards size, efficiency, and sameness above all else. And as that system grows, the question isn't whether Vanguard is plotting a great reset. It's whether we're all sleepwalking into a future where every choice looks the same, every company acts the same, and the wild, unpredictable spirit of American capitalism quietly fades away. But even empires built on efficiency and sameness aren't invincible. In the next chapter, we'll explore the forces that could disrupt Vanguard's dominance and what that means for the future of your money.